We're about to enter one of the most important years in modern financial history, 2026. Between rising interest rates, political uncertainty, AI disrupting job markets, global debt levels exploding, and real estate swinging between bubbles and corrections in key markets, investors need a new kind of strategy. Not one built on hype, not one built on predictions, but a strategy built for resilience, cash flow, and freedom. And that's why today, I'm walking you through the 2026 investing blueprint for passive income. Because while most people are staring at the headlines, reacting to fear, the people who are going to win in 2026 are the ones building quiet income machines today. This isn't about getting rich tomorrow. It's not a 10x your money now video. It's about how to position yourself through 2026 and beyond in a way that gives you actual control over time, money, and your future without needing to flip houses, trade options, or watch the market every hour like a hawk. I'm going to break down the assets, the habits, and the vehicles that I'm personally building into my portfolio for one very specific goal: to generate consistent monthly income that shows up whether the economy grows, stalls, or even shrinks. Let's start with mindset, because this is where most people screw it up before they even begin. Most investors fall into one of two groups. Group 1 is obsessed with growth. They chase the next big stock, the next hot ETF, the fastest gains. Their portfolio is like a tech startup, exciting but fragile. One big crash, and all their progress evaporates. Group 2 only cares about safety. They put everything into bonds, savings accounts, or dividend funds and hope it's enough. But here's the problem with either extreme. One gives you adrenaline, the other gives you security, but neither builds sustainable wealth unless it's done with strategy and context. In 2026, both of these groups are vulnerable. Growth chasers could get crushed by interest rate volatility and geopolitical swings. And extreme safety seekers could lose purchasing power slowly and silently to inflation. So what's the solution? Blend the best of both worlds. In my blueprint, we use assets that grow over time and pay us to wait. The foundation of my 2026 passive income plan is built on dividend-focused ETFs. These aren't just convenient, they're efficient. They give you cash every quarter, often every month, and they reduce the pressure to time the market or guess which stock will outperform. Instead of waking up to meaningless price swings, I wake up to deposits. Because these funds are built on companies that know how to generate real profits and share them. They include businesses that pay you even through recessions, that have increased dividends year after year, even during the 2008 financial crisis and COVID. That's the consistency I'm building my future on. Let's talk about specifics. ETF number 1 on my blueprint is SCHD, the Schwab US Dividend Equity ETF. It's not flashy, but it's become one of the most trusted dividend ETFs in the world for one reason: it screens for quality. Every company in SCHD is picked based on 4 filters: dividend yield, consistency, profitability, and financial health. These are not speculative growth stocks. These are proven machines. Think Coca-Cola, PepsiCo, Home Depot, Verizon. SCHD's current yield hovers around 3.4%, but that's just the starting point. It's increased its payout consistently, which means if you're reinvesting those dividends right now, you're quietly stacking shares and accelerating your yield on cost year after year. Then we have ETF number 2, JEPI, the JP Morgan Equity Premium Income ETF. I know it's more complex, but listen to this. This fund combines stock ownership with an income-enhancing overlay. It uses options, or rather, covered calls, to deliver a payout that often exceeds 7 to 9% annually. Yes, that's correct. JEPI is designed specifically for current income. That kind of yield, when layered into a broader strategy, can drastically close the gap between where you are and how quickly you can achieve meaningful passive income. Just remember, JEPI isn't built for growth. It's meant to produce steady cash. That makes it perfect for those seeking income now, not speculation later. ETF 3 on my 2026 blueprint is VNQ, the Vanguard Real Estate ETF. I include real estate because I want exposure to tangible, inflation-resistant assets. VNQ owns large-scale real estate investment trusts, REITs, which hold everything from apartment complexes to communication towers, office buildings, and even self-storage facilities. Unlike physical rental property, there are no tenants to manage, no roofs to fix, no loans, Just income. V&Q's yield typically stays between 3.5% and 4.5%, and it adds a layer of diversification that's not perfectly correlated to the S&P 500. Now, if you combine these three ETFs, SCHD, JEPI, and V&Q, you can create a portfolio that automatically pays you monthly or quarterly without needing to sell shares to draw income. In fact, with smart allocation, this combo can target around 5 to 6% blended yield, depending on market conditions. Think about that. A $100,000 portfolio with this combo could feasibly throw off $5,000 to $6,000 per year in passive income. That's $400 to $500 every month. Completely hands-off. How do you structure this? Personally, I use a 50/30/20 split. 50% in SCHD for stability and growth, 30% in JEPI for high-yield income, and 20% in V&Q for real estate exposure. This blend gives me balance across sectors, yield ranges, and risk profiles. When SCHD grows slowly but consistently, it anchors me. When V&Q fluctuates with market cycles, it helps me stay diversified. When JEPI pumps out income, it covers lifestyle or gets rolled into reinvestment. If you're skeptical about all this, I get it. I used to be too. The truth is we've all been conditioned to chase big wins. Most finance channels say, double your money fast, or buy this crypto now. But the most impressive portfolios I've seen aren't the fastest growing ones. They're the ones giving people their time back. This is what separates wealth from financial noise. Wealth buys you out of needing to check apps every 10 minutes. Wealth lets you walk away from toxic jobs, not just afford nicer vacations. So much of success in this game comes down to choosing boredom over bad decisions. Passive income isn't sexy at first. Watching $41 land in your account from dividends might not wow you. But when that $41 becomes $78, then $153, then $300 and more over time, without increasing your effort, that's when it clicks. You don't need a $10 million portfolio. You need a strategy that makes your money pay you every month without touching the principal. That's why 2026 is such a big year. With higher interest rates, slowing growth, global instability, and tightening access to cheap money, you will need a system that works through the chaos. This blueprint, it was built for that. Let's walk through exactly how you can start building this passive income engine, step by step, in 2026, regardless of whether you're starting with $100, $1,000, or $10,000. Too many people think you need a massive lump sum to begin investing, but the truth is, the strategy beats the amount. A perfectly executed $500 habit will always outperform a $5,000 one-time guess. So we don't aim for perfect. We aim for consistent. Step 1 is selecting your brokerage. If you don't already have one, pick a platform where fees are low, execution is fast, and the interface is solid. Vanguard, Fidelity, Schwab, SoFi, M1 Finance. Take your pick. Most of them offer fractional shares now, which completely removes the barrier of high share prices. You don't need $100 to buy one share of something anymore. You can invest with just $1 and still build your income stream one piece at a time. Step 2 is automation. This isn't optional. This is how you win. The real edge in 2026 is not beating the market. It's beating your own emotions. And automation removes emotion. Set up auto transfers from your checking account to your brokerage based on your pay schedule. Get paid? A piece of that hits your investment account before you even see it. Set recurring buy orders for your ETF combo, SCHD, JEPI, V&Q. Whether the market is up, sideways, or falling apart, your system runs. That's how wealth is built. Quietly, in the background, with no drama and no second guessing. Third comes tracking. And no, I don't mean obsessing over price charts. I mean tracking your dividend income, because that's the number that actually matters here. Start a simple spreadsheet. Date, ticker, amount paid, total for the month. When you see that number rise every quarter, it becomes addictive, in a good way. You start realizing, this month paid my phone bill. Next quarter might cover my groceries. Watching your dividend income grow is like watching financial freedom come to life, in real time. And it never gets old. Now, let's be ultra-realistic. In the first 6 months, your income growth will feel slow. That's not a bug. That's how compounding works. The first $10 in dividends will feel insignificant until the next one is $13. then $21, then $44. Time and reinvestment are doing the heavy lifting. The secret most people never learn: success is boring before it compounds. But after that, it's unstoppable. Let's run real math on it. Say you invest $700 per month into this ETF combo. That's $8,400 per year. With an average yield of 5.5% across SCHD, JEPI, and VNQ, you're earning roughly $462 per year in dividends on year one. Reinvested. Add another $700 the next month. Now you're earning dividends not just from your contributions, but from last month's contributions. Layer this over time. Without adjusting anything, after 5 years, that $42,000 invested turns into over $54,058 with dividend compounding and basic appreciation. But more importantly, your passive income will have jumped from $40 per month to $250 plus per month. And that's without any extra effort or work. Now imagine raising your contribution just a little bit each year. Maybe next year you do $800 per month. The next, $900 per month. Or maybe you pick up a small freelance income or cut one luxury subscription and funnel the savings directly into your ETFs. It's not about budget starving your life. It's about shifting dollars toward freedom. Every $100 saved, when directed into this system, is like hiring another employee to work for you relentlessly, 24/7, through all market conditions. Here's a mindset shift I want you to remember going into 2026. Your goal isn't just passive income. It's predictable freedom. The difference between rich and wealthy is that rich runs out. Wealthy doesn't need to check the total, they check the cash flow. That shift is everything. And that's especially important heading into 2026 because the noise is only going to get louder. Stocks will rise and fall harder. Clickbait videos will try to scare you. The government might drop new tax rules. Recession headlines will trend on Twitter. You know what won't change? JEPI sending a distribution. SCHD quietly increasing its quarterly payout. VNQ paying its shareholders long after people have moved on to the next crisis. That's the quiet power of income-based investing. Let's talk about reinvestment versus harvesting. In the early years of this strategy, you absolutely want to reinvest every penny. Those little pieces of dividends are fuel for your fire. You don't need the income yet, let it build. But once your income starts approaching a level where it covers a utility bill, then a week's worth of groceries, then a mortgage payment, now you have options. You can choose to reinvest for growth, or start using some of that income to live with more flexibility. That is called milestone-based unlocking. You don't touch your income until it replaces something tangible. Then, it becomes your personal freedom budget, built entirely from ETFs. You'll also want to manage allocation. Over time, your JEPI position may end up delivering way more income than SCHD or VNQ. But remember, high yield also comes with slightly more risk. So every 6 months or so, check your weights. You don't need to rebalance constantly. You just need to make sure no single fund dominates in a way that breaks the balance between growth, income, and diversification. Think of it like this. SCHD is your slow-growth oak tree. JEPI is your high-yield garden. VNQ is your real estate hedge, strong when rates fall again. Together, they build a forest of monthly payouts. Now let's talk about sequencing. 2026 is looking to be the pivot year after years of economic reset. Rates have risen. Debt is high. Growth has slowed. Asset prices are stabilizing. But here's the opportunity, this moment. It's the base layer. This is the time to plant. The timing is never perfect. But smart investors don't buy when it's perfect. They buy when it's consistent. You show me someone who bought monthly from 2016 to 2023, and I'll show you someone who quietly built wealth through everything. COVID, inflation, rising rates, bank collapses, tech layoffs. The world didn't have to be calm. Their system was. Let me tell you a quick story. A friend of mine started investing in January 2019. His first deposit? $300 into SCHD. He didn't know what he was doing. He wasn't tracking dividends, didn't think about allocation. He just knew he wanted to begin. Every month, he added a little more. Sometimes $200, sometimes $500. Not once did he try to time the market. He didn't stop during COVID. He didn't pause when inflation news hit. Fast forward to today. His account now pays him a little over $310 every single month. $310. Without taking on high risk. That's money he doesn't have to work for. That's his internet, phone, and groceries, paid by a few button clicks years ago. And the best part? He's not even close to done yet. He plans to continue for another decade. By then, we estimate his income will pass $1,200 per month, what many people in retirement get from Social Security alone. That's the quiet power of compounding income strategies. It's rarely loud. You don't see it trending on Twitter. It's not sexy, but when you zoom out long enough, you can't deny its force. That consistent effort, executed monthly without fail, turns into exponential change over time. It's wealth without the chaos. And that brings me to a big point. You do not need to max out your savings rate on day one. You just need unbreakable consistency, automation, discipline, structure. Those are your weapons in 2026, not risk or leverage. If all you can invest is $250 per month, that's fine. Just automate it and commit to it like it's your rent. Then raise it slowly. Let raises, side hustle surplus, or found money be your upgrades to income, not lifestyle inflation. Let's zoom in on how that creates freedom in phases. At around $300 per month in passive income, people begin to feel encouraged. The mindset shift starts happening. They feel less dependent on every paycheck. At $500 per month, it starts to feel real, as if you're gaining momentum. That income can now cover utilities and groceries, even during market downturns. Hit $1,000 per month, and something incredible happens. Your portfolio income has now become the same as most people's part-time job. But you didn't have to clock in. You didn't trade time. You just created something that pays you to wait. At this stage, you have more flexibility. You don't have to retire in the traditional sense, but you can work less. Take creative risks. Walk away from toxic job environments or restructure your career around passion instead of necessity. And all of this starts, often, with someone watching a video like this and finally deciding that one consistent investing habit beats one-time brilliance. So now let's address the fears that creep in for new investors. People always ask, won't I lose money if the market crashes? What if ETFs stop paying? What if my income isn't enough? These fears are valid, but they're usually misunderstood. Let's address them one by one. First, yes, markets can and will crash. That's not a bug, it's a feature. Declines are part of the game. But the key distinction is this: market price drops. Dividend income in high-quality ETFs often doesn't. JEPI, SCHD, and VNQ all continued paying through volatility. Why? Because they're built on real businesses making real money. Even during COVID's worst months, guess who still paid dividends? These ETFs. It might fluctuate slightly, but it doesn't vanish. And when share prices do fall, your reinvested dividends buy more shares at a discount. That's the difference between a setback and an opportunity. Second, the idea that ETFs could stop paying is largely fear-based unless you're chasing high-risk yields from poor-quality funds. SCHD has a track record of increasing payments every single year. So does VYM, which could also be a substitute or complement to this strategy. JEPI uses a smart equity overlay that resets monthly. It's not dependent on luck, but structure. You are investing in systems, not hopes. And systems are what thrive when hype dies. Third, what if my passive income isn't enough? Well, of course it might not be at first. That's why you compound. That's why you build. This isn't get rich quick, it's buy freedom slowly. Most people overestimate what they can do in 6 months and underestimate what they can build in 6 years. If your strategy gives you $200 per month this year and $800 per month by year 5, that's exponential movement. That's called stacking time with capital. Now, here's another layer of strategy that few retail investors talk about: laddering ETF income. Because not all ETFs pay monthly. SCHD and VNQ pay quarterly. JEPI typically pays monthly. So how do you smooth out the income so you're getting consistent cash flow each month instead of spikes? By layering. You can build your core on SCHD for quality, JEPI for monthly cash flow, and then sprinkle in funds like QYLD or PFFD if you're okay with a little more risk for yield smoothing. Some people even use a short-term bond ETF like ICSH as a cash parking spot that pays monthly. The goal here isn't maxing every dollar of income. It's engineering your portfolio so you get cash flow every month while still growing long-term wealth. Another concept I want to cover: yield isn't everything. New investors love to chase the highest dividend yields. They'll put money into something yielding 12% without realizing that in 6 months, the fund could cut its payout or lose all capital appreciation. That's why JEPI works. It's structured for income, but manages downside. That's why SCHD is the anchor. It balances growth and yield. VNQ provides real estate exposure, not just for diversity, but because REITs must pay out most of their profits in dividends. These aren't just tickers, they're puzzle pieces with different purposes. Put them together right, and they form a system. So what happens if the market in 2026 never recovers? What's the worst case? If we're talking about reputable funds with strong business models underneath, nothing drastic happens. Let's say SCHD drops 15% in price. Guess what? Dividend payouts might still stay stable, and your income stream? Still functional. Meanwhile, all reinvested dividends, at lower prices, are turbocharging your future returns. That's the flip most people miss. The rough patches are where wealth accelerates, if your strategy doesn't break under pressure. Once you've mentally made peace with that, you're unstoppable. Because now you're not checking the market for emotion, you're checking it like a business owner checking cash flow. And if there's one key takeaway from this entire blueprint, it's this: predictability, performance. Your future lifestyle is determined more by the stability of incoming cash flow than the headline value of your portfolio. And the good news? These ETFs make that kind of income predictable, even at modest growth, even through uncertainty, even if you never max your contribution. Let's paint a picture of how life feels on the other side of consistent investing. You wake up, it's a random Tuesday in March. Your schedule is light. You go to make coffee and check your phone. There it is, dividend paid, $178.36. You smile a little, but it's not a surprise anymore. It's just part of your routine now. A few days later, another $112. Then, toward the end of the month, $211. Altogether, that's nearly $500 in passive income just for the month of March. No effort, no side hustle, no second job. Just the result of past decisions continuing to pay you. A financial echo that keeps giving. This is what the 2026 investing blueprint is really about. It's more than cash flow. It's about replacing financial anxiety with certainty. You don't need to retire early to enjoy what that income gives you. You just need to reach the point where you're no longer trading all your time for money. That $500 a month could buy serious optionality in your life. Fewer hours at work. The ability to say no. A plane ticket to somewhere you've been avoiding because of cost. It could be the difference between staying in control or feeling stuck. Now, I want to emphasize, it's important not to overcomplicate this plan. The real estate, the automation, the smart investing strategy, all of that is just noise without one key ingredient: belief. Not in markets, but in yourself. You have to believe that small actions, done consistently, create massive change. You have to trust that boring wealth actually works. Because here's the thing, you won't feel this in week 1 or month 2. There won't be fireworks. In fact, at first, it'll even feel like it's not working. The dividends will be small. The portfolio won't look impressive. People chasing hot stocks will seem smarter than you. But then, somewhere around month 6, or month 9, or year 2, you'll step back and realize you've created something that others only talk about. Something that scales while you sleep. That's what makes 2026 such an opportune year to do this. We're in a temporary builder's era. While everyone argues over whether a recession is coming, or inflation is back, or if the Fed will pivot, you can completely ignore all of it and quietly build your system. When rates stabilize, when markets recover, when investor focus returns, you'll already be months or years ahead. Don't wait until dividends are back in style to realize you missed the entire accumulation phase. Let's talk goals. People always ask, how much should I aim for? The answer is different for each person, but here's a helpful frame. Build your portfolio to cover one expense at a time. Don't even focus on a number like $1 million portfolio yet. Start with, can my dividends cover my phone bill this month? Once you hit that, the next goal might be utilities, then groceries, then rent. Before you know it, you've built the beginnings of a complete lifestyle machine. And instead of saving to retire, you're starting to live through your investments today. And on your way there, keep reinvesting. Reinvestment is how middle-class investors become financially independent. When you automatically reinvest every dividend, you add new shares without lifting a finger. Those new shares start generating dividends themselves. Then those dividends feed more shares. This is when exponential return mechanics begin, the true wealth curve. Another major key in 2026 will be cost averaging. With volatility still lingering from the last few years, prices are bouncing. Don't try to outsmart this. Commit to a consistent contribution schedule, weekly, bi-weekly, monthly. When people chase the best entry, they often wait too long, miss the compounding window, and end up contributing less. Time in the market will beat timing the market almost every time, especially when you're focused on income, not just capital appreciation. Now let's be realistic. You may need to shuffle things along the way. Maybe VNQ underperforms because of sluggish real estate in 2026. Or maybe you find that JEPI's yield compensates for lower growth. Or SCHD fits your strategy, so while you gradually increase weighting. These are evolutions, not mistakes. As long as you're anchored in high-quality, dividend-focused ETFs, automated contributions, and passive reinvestment, you're doing it right. The blueprint is the baseline. The adjustment is your personal fit. Let's address portfolio fatigue. Sometimes this strategy gets quiet. It feels invisible. Other people are flashing meme stock gains or buying rental properties left and right. And here you are, collecting $83 in dividends on a random Tuesday. But here's what they won't tell you. Fast money usually fades. The guy who made $10,000 trading options last month may lose $7,000 this week. The Airbnb empire guy may be facing housing regulation crackdowns by the city. Meanwhile, you're still getting paid, still reinvesting, still growing. You're not chasing. You're compounding. That emotional security is hard to explain until you feel it. But when you do, everything else seems unnecessarily complicated. You don't check price movements hourly. You don't get paralyzed by market news. You have a machine to feed, and it feeds you back. That kind of investing doesn't just build money. It builds peace of mind. And let's be honest, that's what most people actually want. Let's return to goals for a moment. If you invest $1,000 per month into this passive income blueprint in 2026, that's $12,000 per year. At a 6% blended yield, you're generating $720 in year-one dividends. Modest, but powerful. In 5 years, with reinvestment and modest asset growth, you're likely seeing more than $5,000 per year in passive income. That's over $400 per month, just from being consistent. With increased contributions, that could become $600, $800, $1,000 per month. And you haven't sold a single share. Retirees are discovering that passive income from ETFs like these is more emotionally freeing than traditional stock portfolios they have to slowly sell off. Why? Because dividend income isn't psychological torture. You don't have to wonder if now's the right time to sell. You just live off what your portfolio produces. You're not eating the tree, you're picking the fruit. This also reduces something called sequence of returns risk, where selling off assets during a market downturn damages long-term wealth. If you're living on dividends instead of sell-offs, you remove timing risk entirely. That's next-level investing, and it's how smart people are preparing for uncertainty in 2026. And here's the final benefit I'll share in this section: legacy. Building an income-based portfolio gives you something permanent. Your kids don't just inherit money, they inherit an income engine. If you never sell your shares, your wealth continues to grow. Your portfolio becomes multi-decade ownership in the smartest companies and most powerful real estate on earth. And the cash keeps flowing. That's what makes this blueprint different. It's not get in, get rich, get out. It's build it once, benefit forever. Let's wrap it all up and give you exactly what you need to move forward. Because watching a video is one thing, but taking action is what pins the turning point in place. So what do you now know? You know that 2026 isn't a year to guess or gamble. It's a year to systemize. You've seen clearly that emotionally safe investors don't just diversify their holdings, they diversify their cash flow. That's what this blueprint is about: stability, simplicity, sustainability. You've also learned that 3 funds, SCHD, JEPI, and VNQ, can be combined in a smart way to produce real results. Together, they power a diversified stream of income rooted in real businesses, real assets, and real strategies. This isn't theoretical. This isn't a backtest. This is live, implementable, and proven. Whether you're starting with $100 or $100,000, The mechanics work just the same. You've seen the power of automation, the secret weapon that quietly defeats emotion. You understand that tracking dividend income gives your investing journey clarity you can feel. And you've seen the roadmap. From utility bill replacement to lifestyle freedom, you don't need wildly risky returns to buy time back. You just need consistency and a solid system. Now let's zoom in on what happens when you follow through. Most people don't make bad financial decisions because of markets. They do it because they operate without a blueprint. They don't know what to invest in, when to contribute, how to build income. So they guess. They get excited by hype and freeze during downturns. But you won't be one of those people. Because now you're armed with a plan that puts you in control, and that's everything. $500 invested the right way today isn't just an investment. It's a rejection of financial anxiety, a vote for peace. It's stability in a storm of uncertainty. It's the slow climb toward the moment you log into your brokerage one morning and see an entire lifestyle paid for, automatically, by returns from smart, boring ETFs. And when that moment comes, it won't be luck. It will be the reward of boring excellence, executed month after month through this strategy. That's what nobody talks about. Wealth comes not from what you hope the market does, but from what you automatically do when no one is watching. This entire blueprint can be implemented by any one person watching this video today. No insider info, no portfolio manager, no trading signals. Just you, a brokerage account, a calendar reminder, and 3 ETFs that work together to generate cash flow while you're living your life. That's the part people miss. You still live. You don't need to bury yourself in spreadsheets or financial news. You don't need to pop into Reddit to search for the next high-yield pick. You tuck away your contributions, the deposits show up, the system runs, and slowly, month after month, the life you want isn't just something you dream of. It's something you've been building brick by brick the entire time. So, if you're sitting there right now, wondering, what do I do next? Here's exactly what I'd tell you, friend to friend. Open your investing app and buy your first piece of SCHD. Just a share, even a fraction of one. Set your recurring deposit, maybe $50 a week, maybe $500 a month, whatever works. Add JEPI and VNQ over the next 30 days. Set each one to auto-invest. Then turn on dividend reinvestment. You don't have to go big. You just have to start. Because once this engine gets rolling, it gets harder to stop. And the moment you get your first dividend payout, even if it's just a few dollars, a light turns on. You'll never want to go back. This is where the game changes. Not for someone else. Not for a future version of you. For you. Right now. Now, before this video ends, do me a favor. If this helped shift your mindset, if it gave you clarity or inspiration or even a game plan, click the like button so YouTube shows this blueprint to more people who need it. And don't forget to subscribe if you haven't yet. That tells me you're serious about financial freedom, and it means you won't miss the next piece of the roadmap we're building here. In the description below, you'll find a free downloadable worksheet I made for this strategy. It includes the ETF tickers, different allocation options, a dividend tracking sheet, and more examples on how income compounds over 5, 10, and 20 years. No email sign up. Just click and use. And if you want me to personally break down this blueprint based on your income, your age, or your time to retirement, leave a comment. I'll be checking and replying every day this week. But for now, walk away with this. Your future income starts now. Not in retirement. Not in 10 years. Not when life slows down. The minute you start investing in income, even $1 at a time, you start living on your own terms. This has been the 2026 Investing Blueprint for Passive Income. Simple, repeatable, scalable, and yours to build. Thanks for watching. Stay consistent, stay patient, and let your money keep working long after you stop thinking about it.